These clients in this episode would have given up 61.33% returns if they had withdrawn money from their IUL instead of borrowing from the insurance company using their cash value as collateral. So many times people say, well, why would you borrow from your IUL when you can just withdraw the money? Well, I'm going to show you these clients would have given up 61.33% rate of return in one single year had they withdrawn their money instead of borrowing from their IUL. Get ready. This is going to blow you away. So I'm Doug Andrew, and I've been helping people optimize assets and minimize taxes now for north of 5 decades, helping many, many thousands of people prepare for a comfortable retirement. My favorite financial vehicle, without question, is a properly structured, max-funded index universal life, okay? Now, when it's structured correctly and funded properly, it knocks the socks off of other alternatives like IRAs or 401ks. They're tax-free. But some critics out there go, well, if you need to access money out of there, you're recommending they borrow? Why would you borrow your own money? Here's why. Get ready. First of all, let's cover how money works. When you use the cash inside your max-funded index universal life policy for living benefits, okay, you are understanding how to become your own banker, okay? So let me just ask you this. A bank or credit union or even an insurance company, they pay interest on money that's in their institution that actually is not their money. It's OPM, other people's money, okay? They are borrowing OPM. Now, why are they so willing to pay interest? Are they just a benevolent institution paying you interest and then they keep your money in a vault? No, they borrow and pay you 2, 3, 4, 5% or higher, and then they go out and invest it or loan it back out again at higher rates, and then they make a little 3 or 4% spread, sometimes less, and they make billions and trillions of dollars. Okay, this is how money works. They're willing to pay interest to make more interest. If they stop paying interest, they would wither up and die. You have to understand that first, okay? So a laser bank, this is a max-funded index universal life. We call it a laser fund if it's structured correctly and funded properly. We use what is called the laser banking concept. So when you accumulate, let's say $1 million, and if you don't have $1 million, you only have 100,000. Hello, just extrapolate from this example. It's 1/10. But if you have 10 million in your IUL policy, which many of our clients do, it's 10 times this example. I'm just trying to keep it simple. When you have $1 million of cash value in your policy, you can withdraw that million. It's liquid, okay? But if you withdraw $1 million, it's no longer in there earning interest. But if you borrow, you're actually borrowing from the insurance company and leaving the million there. You're using the $1 million as collateral to be able to borrow $1 million from the insurance company. Now, the insurance company is very willing to loan you $1 million if you have $1 million sitting in their company as collateral. You don't have to qualify. They don't check your credit, okay? And so you borrow $1 million, and people say, well, why would you do that? There's a cost. Well, you can borrow at a zero net cost. They can loan you $1 million and charge you 2% for the year, 20 grand, and they'll credit you 2% on the $1 million you left there as collateral. So they charge you 2, they credit you 2. That's called a zero wash loan. Why would you do that? Because loan proceeds are tax-free. So if you access $1 million using the smart way by borrowing, it doesn't cost you anything, but it makes it tax-free. Because for decades, when you borrow money, you don't have to pay taxes on borrowed money. Does that make sense? The loan is not due and payable during your lifetime. It's paid off or washed away when you die, okay? Now, many of my clients are savvy, and so they use what is called an indexed or alternate loan. This is where the insurance company might charge you a higher rate, like 4 or 5%. Let's use 5%. So why would you do that? So the insurance company is going to charge you 5%. That's 50 grand if you borrow $1 million. You don't have to write out a check for 50,000 at the end of the year. They will deduct that from the money that you're earning that's sitting there in the IUL. Okay. Now, most of our clients have been earning at least 2% higher rates of return than that borrowing rate, 7%. This is like a no-brainer. 7.2% is the worst rate of return in the worst decade since the Great Depression. 7.2%, the year 2000 to 2010. So if you borrow at 5 and you earn 7, and that's $20,000 more that you're earning that you otherwise would not earn if you withdrew your money, because it wouldn't be in there. So when you earn $20,000 more, 2% more, if you're retired, instead of pulling out maybe 7 or 8% a year in a payout, 70 or 80,000 a year, you can pull out another 20,000. Instead of 70, you can pull out 90,000 a year without depleting your principal because you're earning 2% higher than the borrowing rate. If you don't understand this, you need to see some illustrations. But what this does, it allows you, if you're taking retirement income, many of our clients, for every $1 million, they could pull out $80,000 a year, okay, and just withdraw that. But instead, they borrow $80,000, and that $80,000 is actually that collateral is earning, okay, more like 10% because we diversify. But even if it's only earning 8, if it's earning 8, you'd think, well, if you pull out more than 8%, you're going to slowly deplete your principal. No, because if you're only earning 8, but you borrow it out, you're earning 2% higher. And so you can take 2% higher payout, meaning instead of 8, you can take 10. So you can take out $100,000 a year and not deplete your $1 million because you are using the arbitrage. You are actually borrowing $80,000 and earning 2% more than that 8. You're earning 10. And so this is an incredible concept. You have to see a full illustration of taking out a 10% payout from age 65 to age 120 to see how powerful this is on a policy that's only earning 8, and how you can pull out 10% every year and not deplete principal, okay? Now, let me show you how powerful this is. Many of our clients, okay, if they have $1 million and they borrow at 5 and they keep earning 10, how much more is 10 than 5? Don't say 5, it's 100% more. Why would a bank or credit union, okay, credit you or pay you 5% interest on your savings or a CD in a bank? It's because they go out and they earn 8, 9, 10% higher, and they make millions and billions doing that. So you need to understand that concept, first of all. This is what many business owners do. Well, let's go to $1 million of cash value that one of my clients borrowed from in the year 2017, okay? So we have the difference between employment cost and opportunity cost. A lot of times people don't understand that difference. If you borrow money, you're going to incur a cost and interest, right? But I don't just borrow and bury it in the backyard or put it in a vault. I'm my own bank. I'm going to put it to work like an employee. Why would you pay an employee 50 grand? If that employee makes you an extra 100 grand, I'll do that all day long. I'm willing to pay the employee that's going to make me twice as much as they cost me, right? So there's an employment cost. Otherwise, people say, well, no, I don't want to pay that. Well, if you don't, it's still costing you because that's lost opportunity. That's called an opportunity cost. Some people never get this, so watch very, very close. In 2017, I had a client that needed $1 million for about a year out of his IUL policy to tie up with an earnest money, I think it was a $17 million strip mall. He likes to buy real estate, strip malls, big apartment complexes, and fix them up and then flip them. He doesn't like to still own them as a landlord because he has clients who want to sell and he has other clients who want to buy. So he called me and he said, Doug, I need $1 million out of my IUL policy because I need a 3% earnest money agreement on this $17 million property. And he's done this before many times. He knows how money works. And he says, send me that form. And well, it's a one-page form, and he puts his name and his policy number for his IUL. And it says, do you want to withdraw $1 million? No. If he withdrew $1 million, he would miss out on earning the rate of return in the year 2017. He doesn't want to miss out on that. He understands how money works. So he said, no, I want to borrow $1 million. I said, you want to borrow at the zero net cost? You want to borrow at 2% and be credited 2% so that this $1 million is tax-free. But there's no cost to borrowing your money. No, I don't want to do that one. I'm going to go for it. You can charge me 5%. This is called an index loan. So he agreed to pay 5% on his $1 million. That's $50,000 for the year. He didn't have to write out a check for that because that year his $1 million capped out, okay, and was credited 25% on the $1 million that he did not withdraw. He left it there, and it earned $250,000. You take $250,000 minus the 50, he netted 20% on his $1 million that he left in the company because he borrowed $1 million from the insurance company. He made $200,000 on the $1 million that was collateralizing the loan, tax-free, while he bought and fixed up and flipped a strip mall and made $2 or $3 million. This is what smart people do. Okay, now let's go to what I started out with. These are clients in the year 2020 to 2021. What happened in March of 2020? The stock market dropped, the S&P dropped 30% in 1 month, March of 2020, because of COVID-19. Now, when there's anxiety, that spells opportunity. We contacted over 800 of our clients, and with one keystroke, we had them link to a 1 year point-to-point with no cap. That's called a threshold strategy. We usually don't use threshold strategies except when the market drops. That spells opportunity. And so the reason why we usually don't use a threshold strategy because the insurance company has no cap on what they'll credit you, but they subtract 5%. So if we're averaging 12, you subtract 5, you're only netting 7. By using a cap strategy, if we earn 12, we net 11 most of the time. But if the market has a chance of going up dramatically, we'll switch to the threshold. So that's what these clients did. So this particular client, they didn't put all their money in that 1 year point-to-point with no cap from March of 2020 to March of 2021. They had $6,000 that they left in a 1 year index that got credited 9%. They had $6,200 that got credited 12%. Another $6,100 that got credited 7.25% that year. But the other half of that money, okay, which is $18,000. So half of the 18 was diversified among these three and got an average return around 9 or 10%. This, though, got credited 61.33%. Because the market was up 66.33 minus 5, they got credited 61.33. So that 18,000 grew to 29,000. So let me pose this. This client, if they needed money in the year 2020 because of COVID-19, okay, this client could have borrowed 17,000 out of this policy. Why would he be better off doing that than just withdrawing 17,000? Okay, listen. If he withdrew 17,000, he would have missed out on 61.33%. By borrowing from the insurance company 17,000, okay, on 17,000 on the loan, they would have charged him $850. That's 5%. While making $10,426, that's 12 times or 1,200% more than they charged him by borrowing from the insurance company instead of withdrawing his money. He would have given up 61.33% rate of return that year had he withdrawn his money, like a bunch of people out there say, well, why would you borrow when you can withdraw? That's why. Let me show you one more example here. This client had $872,000 in March of 2020 in his policy, and he got credited 61.33% on that. That wasn't all his money in this policy. This is just a portion. So he had $852,000, and it got credited $535,000. Tax-free, net 61.33%. So 852,000 grew to 1,387,000. Now, let's use this example. If this client needed money, he could have borrowed 800,000 out of that 852,000 in the year 2020 if something happened and he needed it. Could he have withdrawn 800,000? Oh yeah, he could have withdrawn it, but if he would have withdrawn it, he wouldn't have made $500,000. By borrowing, okay, 800,000, 5% interest on that would have been 40 grand. He didn't have to make out a check for that because he made on that 800,000, 490,000, 12 times what the interest was charged, the 5%. That's why he would have missed out on making, $500,000 if he had withdrawn money out of his IUL instead of borrowing from the insurance company using that 800,000 as collateral. Are you getting it? Let me show you one more. If that client had used a multiplier means if you feel really bullish about America, then you tell the insurance company, you know what? You can take another 7.5% of my cash value. 7.5% of 852,000. Okay, if you were to do that, that would have been maybe another 50, 60 grand that you're telling the insurance company. I'm willing to lose maybe 7.5% if I guess wrong, but the chance that the market was going to be up was substantial. But if you let the insurance company have another 7.5% of your cash value, so that if the market goes down, you don't make anything, but you don't lose. Zero is your rate of return. Zero is your hero. Here, you're capping your loss maybe at 7.5%. If this client would have done that, they would have got 2.7 times the $500,000. Okay, and so you, if you get that, what is called a multiplier, then that 2.7 times less 7.5%. 61.33% times 2.7 is 165.59 minus the 7.5. You're netting 158. Okay. I mean, how would you like to get 150% rate of return on your money? If you would have withdrawn the money, you would have missed out on that. If you borrowed from the insurance company using that as collateral, you would have made a ton of money on top of the 5% that's being charged. Does that make sense? So if you want to actually understand this more, I would strongly recommend that you understand Property Structured Max Funded Index Universal Life, what I call a laser fund. Claim a copy of this book. Now, it's a 300-page book, which is actually two books in one. This side, the white side, is the left brain. 14 chapters, all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner and you learn more by stories and examples, you flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. If you want to use your whole brain, you can use your right brain and your left brain. Now, you simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those formats available for your investment. You can even schedule to attend a free educational webinar. No cost, no obligation. We do these weekly. You can even schedule an appointment with a certified IUL professional to see how a property structured max funded index universal life can do what I'm talking about here, and how you can understand how money really works and not miss out on these wonderful opportunities I've talked about in this episode.